Just Venmo me later. Can I send it from PayPal instead? In today's world where everything is digitalized, money is no exception. Online banking makes it much easier to track your finances from anywhere. And with that, the rise of the company we're going to be talking about in today's video, PayPal. Because of PayPal, cards, cash, checks, you don't need to carry any of those with you. Hey guys, it's Newfire, and welcome to part 19 of my series Triple SMI. If you're new, the series is for investors who are just starting out and want to get to know more about some easy stocks they can place their money in for the long term. The mission, if you choose to accept it, is 25 companies for 25 years. Okay, without further ado, let's get into PayPal. So like I mentioned, you don't need any sort of physical units of money nowadays, like cards, cash, or checks. That's because PayPal's service allows you to transfer money from any device, like your phone or computer. Almost all, if not all stores and restaurants allow PayPal as a valid payment transfer. So if you have a phone, you don't need to carry any other forms of cash on you. You may have also heard of Venmo, which PayPal owns. PayPal and Venmo both offer digital transactions, but Venmo is more utilized for one-on-one money transfers, whereas PayPal is used to pay for goods and services in an official capacity. So now that we've covered that, let's see how PayPal stock fares. PayPal was founded in 1998 and went public 4 years later in 2002 for a price of $13 per share. If you'd invested $1,000 in PayPal then, your investment would be worth $4,560 today. But it gets better, or worse, depending on how you look at it. Because in July 2021, PayPal's stock price reached $300 per share. If you had the fortune to sell your shares at that point, you would have made $22,000 off of an initial investment of $1,000. The reason the stock soared during the pandemic was because people were naturally more forced to rely on online transaction services like PayPal due to lockdown and inaccessibility to physical visits to the store and bank. After the pandemic, the stock crashed down to $60, which is not a good sign for us since we want stable and reliable stocks. Part of the reason PayPal lost some market share is because of the presence of competitors like Zelle, Google Pay, Apple Pay, and some others. So where does this leave PayPal? With growing inflation, people will anticipate a recession and naturally spend less. This hurts businesses like PayPal, who rely on people spending and transferring money. The reason PayPal stock crashed is because investors pull out their money after seeing the company report losses. And if or when it can show signs of overcoming these drawbacks, the stock will reverse direction. As for PayPal's future, it looks to be a tough one. The company hopes to expand its customer base over the next few years and is hoping to achieve that by introducing some new features to make the app more attractive. And while PayPal has been in a slump lately, its success during the pandemic does speak for something. But strong competition may curb that sort of success from happening again. And since the stock is priced low, it might be a good time to buy now since it has more space to grow once again. So that's it. We've covered PayPal as a potential investment, and while it has come down from its peak a couple years ago, the stock still has grown from its initial price. Now it's up to you whether you want to invest or not. Thanks for watching, and remember to invest wisely. Stay tuned for my next video on Samsung, and this is Newfire, signing out.